Good afternoon, everybody. Welcome to our Assessing COVID-19's Impact on Staffing M&A. My name is Jerry Grady. I'm a Managing Director and partner with UHY LLP. I head up our Staffing Industry Practice Unit. And as you know, some of you have been on a couple of our webinars that we've been doing. We have been trying to do a lot of knowledge sharing with the industry. And today we're very fortunate to have Geoff Goldwater from Odell Studner be joining us, as well as Jeremy and Brandon from our UHY Corporate Advisors Finance team. And they really got a lot of good data to go through, giving everyone a really good idea what's going on in the current M&A space. And I think, as you have questions, as most of you have been on some go-to meetings since we've all lived this life, please feel free to use the question box. We will be monitoring that. We have left some time at the end for be able to respond to those. As you see what we have here, we have got about 60 minutes for presentation, about 10 to 15 minutes towards the end for some questions. There will be digital copy of all the slides, and a link is here. And you can also go ahead and we will email those all out as well to everybody. Everybody is muted, as you know. And with that, what I'd like to do is, Jeremy, I'm going to go ahead and hand this off to you and let you go ahead and start.
Great, thanks, Jerry. Happy to be here today. We've got, as Jerry mentioned, a lot of, I think, really good content focused on really the M&A market overall and how it's been impacted by COVID. We also do a bit of a deep dive into the staffing space in particular, focusing on M&A. As well as some risk management impacts during this market. So a place we want to start real quick is a brief introduction to UHY's corporate finance team. So most everyone who knows UHY, you probably know us as a national and global tax accounting and consulting firm. We've got 20 plus offices throughout the US. We have feet on the ground in over 100 countries. With true Big Four experience, and we are focused on the middle market. So our investment banking team, really the UHY Corporate Finance Group, that's all we do is focus on M&A. We've got Wall Street experience, but similar to the rest of the firm, we are literally 100% focused on serving the middle market. So this page is our team. We've got about 12 professionals. This allows you to put some faces with names. We really do offer a full suite of investment banking services. On the top left, sell-side advisory. This is probably where we spend most of our time. Probably 2/3 of our activity in our group is on the sell side. So this means helping business owners, private equity funds that are looking to either sell their business or look for a minority equity partner and really assess strategic alternatives. So strategic reviews, that can be really taking an in-depth look into your business and understanding what alternatives look like. Is now the time to grow through acquisition or organically? Is now the time to do a recap for your business? Or is now the time to take advantage of the M&A market and conduct a sale transaction? Again, we spend a lot of time there. The other buckets, buy-side advisory. On one end of the spectrum, this is us assisting with, you found a target that you like to acquire, and we can help negotiate a deal, work through due diligence, and make sure we get a successful closing, all the way to we can help work with you to devise and execute an M&A strategy. We also have a team outside of our corporate finance team in the broader UHY network that is dedicated to post-closing integration. So really critically making sure that you as a business owner are getting full value for your acquisitions. On the due diligence side, similarly, we're focused on due diligence for acquisitions, making sure we know what you're buying, as well as on the sell side, making sure that we've fully diligenced your business before we go to market and buyers do their own diligence. And then finally, financial modeling, really an outsourced business development group to help bolster your team. And then finally, on the capital raising front, this can be minority equity, but typically is debt capital raising, particularly related to a potential acquisition. As Jerry mentioned, we have a truly national staffing practice. Jerry heads that group up. We are very actively involved in the community, many leadership levels in some of the key industry associations, and we serve over 100 staffing clients around the country. A true full-service investment banking group focused on the staffing space. So one of the key topics we want to talk about today is, before we dive into the M&A market during the pandemic and today and into the future, I think it's really important to understand where we came from and what the market looked like coming into the pandemic, because I think that's going to be one of the key drivers of how quickly we recover. As many know, we've already seen very significant recovery in the number of deals getting done and valuations. We see it in the stock market as well. So again, let's start with, what did the market look like coming into the pandemic? So we had a surge in deal volume, and I think it's important to understand that this wasn't just 2019 or the last couple of years. It's literally a 6-year data set of very strong deal activity. Valuations at all-time highs. It's hard not to have heard the valuation levels that some of your peers may have been selling for. So very strong valuations in the market. 100% cash at close. That is just to say that we're having more success, more cash at close, as opposed to structure in the form of seller's notes and potential earnouts. Now, we still saw those on some deals, but we had a much stronger position to push for more cash at close. And as a seller, more cash at close means less risk in the deal. Corporate buyers, strong balance sheets, lots of capital to put to work. Financial buyers, think private equity funds and family offices. Similarly, a record amount of capital to work. And the data suggests that they've been putting it to work over this last several years coming into the pandemic. And then finally, a very aggressive lending environment. We saw a surge in non-bank lenders, and this really translated to higher leverage multiples on deals, and frankly, much more aggressive terms on transactions. So this page really illustrates some of those points, which is, again, for 2014 through 2019, we saw about 13,000 deals close on average per year, which is really a step change from where we were between 2009 and 2013. That's almost a 40% increase in deal activity. So again, I think it's really important to point out that this is 6 years of momentum coming into this pandemic environment. And then at the bottom of the page, this really illustrates the fact that we've seen almost 10 years of nearly uninterrupted valuation multiple growth over time. If you look back to 2009, when multiples were around 8 times, we've seen about 5 turns increase in total valuation multiple leading to 2019. Now, this is not staffing. This is all deals in the middle market, but really illustrates the point here that valuations were really seeing a lot of strength as well. I really want to point out the bottom chart on this page. This is that same data that we just saw. And what you can see is really one of the key drivers of valuation is the amount of leverage that lenders are allowing buyers to put on businesses. So between 2009 and 2013, we saw that total leverage on deals was around 4.5 times EBITDA. Again, we saw a step change in leverage between 2014 and 19, where these deals were seeing closer to 6 turns of leverage. This is a very big deal for buyers of businesses. And we'll see how that changed, of course, as we lead into the pandemic. So again, a lot of deal momentum, a lot of momentum in the market. And then, of course, the pandemic comes along and has disrupted things significantly. So we saw that deal volume fell immediately and significantly, particularly as we think about, the heart of COVID. It's probably in the late March timeframe when we really saw the magnitude of that impact. But in terms of deals getting done, we saw a lot of deals getting canceled and a lot of deals put on hold. I think it's important to understand that while that was the case, we'll soon see that that's not all deals. So deals were still getting done during the heart of the pandemic, which is important. We saw valuations fall significantly and immediately. We really saw almost a 30% reduction in asset values across the board in early March. Banks obviously and buyers required more structure on deals. So banks and buyers were demanding and requiring more sellers notes, more earnouts on deals, and really requiring more and larger equity checks on transactions. We saw corporate buyers shifting into survival mode, obviously for good reason, focused on their cash flow. But for companies that came into the pandemic with strong balance sheets and access to capital, we saw some of those firms participating in M&A and acquiring businesses opportunistically in this market. And we'll see a bit later some data that suggests that M&A, a good M&A strategy in a challenged market, yields significant returns. We saw financial buyers, of course, the overall amount of deal activity declined as well, but they actually shifted from fewer larger platform deals to more small add-on transactions. Those tend to be lower risk and easier to finance. And then, of course, lenders became quite a bit more cautious in this market. Deals that were closing with financing tended to be deals that were either very far along in late March and April, or deals where you had a very long-term relationship with a lender and a borrower, where there was a lot of comfort around that transaction. It was very difficult to go to a new bank with a new deal in this market. So this page illustrates some of those points. We can see that in the second quarter of 2020, deal volume fell about 50% as compared to quarterly deal volume throughout 2019. So again, a fairly significant drop off. But again, I think it's important to note that there still is a blue bar here. So that means that deals were getting done. The bottom of this page continues the conversation around leverage. So we see the 2014 through 2019 data, again, about 6 turns of leverage. Fast forward to the second quarter of this year, and the average amount of leverage on deals was closer to 3.5 turns. So when you have less debt on a transaction and banks less willing to lend into a deal, one of two things are going to happen. Either valuations come down or the amount of equity required in a deal increases. We'll see that at the end of the day, valuations have actually held fairly strongly, and buyers were actually coming to the table with more equity. So one key question that we want to answer here today is, if I'm interested in selling my business, is this something I can do in this market? Now, a lot of these topics are also relevant for acquirers, but the angle that we're going to pursue here is from the seller's perspective primarily. So can I sell my company in this market? The short answer is yes, but. And I think it's important to realize that that doesn't mean yes, but at a lower valuation. It doesn't mean yes, but not for another 12 months. It means yes, you can sell your business in this market for a healthy valuation, but it's become quite a bit more challenging. We've got a lot more hurdles to jump through, and we'll talk a bit more about some of those today. So again, we saw the chart on the top. Deals are getting done in this market. The bottom chart just illustrates this point that in the past several years, the capital structure in a transaction was closer to 50% equity, but we're seeing buyers come to the table with quite a bit more equity in this market, which just means that corporate buyers and private equity funds with capital available have a significant advantage in a market like this. So I'll shift this over to Brandon. We've talked about deals at the macro level, and now Brandon will talk a bit more about what we're seeing specifically within the staffing space.
Great, thanks, Jeremy. So as we delve into the market dynamics of the staffing industry, you'll notice on the chart there was strong activity leading into the pandemic, aligned with the overall market trend previously outlined. And as expected, we saw staffing M&A decline alongside the market, starting in mid to late Q1 as it reacted to the pandemic's initial shock. So COVID-19 related shutdowns across almost all staffing industry supported end markets really led to that significant spike in unemployment. So obviously there's ripple effect adversely impacted the staffing space, which forced strategic buyers, including public staffing companies, to look inward and shift any focus they had on M&A to more of a survival mode, if you will, during the midst of the pandemic, which they prioritize operations and financial stability. So in addition, many in-process deals were delayed due to COVID, and new deals were put on hold during this period until there were further signs of stability in the market in general. So having said that, there were actually plenty of staffing deals that commenced throughout the pandemic. Actually, 84 staffing deals closed in the US through the 2020 period on the screen, which is slightly lower, again, as expected, compared to activity through Q3 in both 2018 and 2019, which saw 103 deals and 120 deals closed respectively. So while overall deal volume is actually down in the space, we would just like to further highlight that staffing deals were closed during COVID lows. Actually 33 deals, or about 40% of the 2020 deal volume, were actually inked during the height of the pandemic from late February to May. So as we continue to move through 2020, those in-process deals that were previously delayed or the deals that were previously put on hold have been reprioritized as the market has almost fully recovered from its COVID-19 value discount, climbing back close to those pre-COVID levels in the staffing space in general. So this is a strong sign of recovery in the staffing space and a healthy deal environment. We continue to see strategic buyers, including private equity-backed strategic groups, dominate deal activity, holding about 80% of the deals completed in 2020. Those were done by buyers in this category. And we continue to see a strong push from financial buyers in the space as well. We actually saw 12 platform investments made by private equity through Q3 of 2020, and 7 more deals completed as add-on acquisitions to their existing platforms. And to further support our thoughts on the trend that M&A will pick up in the months ahead, we've had numerous conversations with potential buyers and sellers in the staffing space that further supports the inclination that M&A activity will recover fairly quickly, as there's no real shortage of active buyers in many of the staffing segments, with some segments yielding more interest than others during these uncertain times. So moving on to the next page, the chart on your screen actually outlines the breakdown of staffing deals by subsector from 2018 through the third quarter of 2020. And as I mentioned, certain staffing subsector transactions were more prevalent during the height of the pandemic than others, which we'll focus on just a bit. One of those being IT staffing, as it has remained attractive and the most attractive staffing segment for buyers over the past few years. And we anticipate an uptick in IT staffing focused deals to continue as COVID-19's impact on the fundamentals of almost every industry has caused a major shift to remote XYZ, furthering the need for top IT talent and a remote workforce. So while moving on to the light industrial commercial sector, which has also been relatively active over the past few years, this sector is generally viewed as being more cyclical in nature than the staffing industry as a whole. And buyers in this segment were more opportunistic during the heights of COVID and are anticipated to continue this trend moving forward, which we will touch upon a little bit later on in the presentation. And then just wrapping up this slide, healthcare staffing has historically been another attractive sector, and we anticipate will continue to garner interest from buyers and investors as we move into the new normal. So moving on to the next slide, we know that deals continue to get done in this market, and deals were getting done previous to this market. So the question becomes, what types of deals are actually getting done? So this page outlines an overview look at the types of deals that were inked in the pre-pandemic M&A market, which we won't spend too much time on, what types of deals were completed during the pandemic, and finally, what we anticipate the future market to look like as we continue to recover and move through COVID's impact. So on the chart here, beginning with seller type, the majority of deals inked during the pandemic were mainly distressed deals or in-process deals, like I mentioned, that were launched prior to the pandemic. While there were a number of healthy deals, especially in some of those on-trend sectors like IT staffing, the majority of the healthy deals were already in process pre-pandemic. So looking forward, we anticipate that the pent-up demand for the large number of deals put on hold in the space will yield a number of healthy deals as we continue through 2020. However, a number of distressed deals are most likely to take place looking forward, as well as these opportunistic buyers will continue to take advantage of distressed assets in the market. So as we move down the chart to the actual staffing sector row here, we saw a healthy mix of all staffing subsector deals in the pre-pandemic environment, while during the pandemic, outside of those distressed deals noted, the IT staffing space stood out as an outperformer compared to the other subsectors. Almost 40% of the staffing deals completed in the first half of 2020 were IT focused, as we previously mentioned, just reinforcing that IT has really been an on-trend subsector. So looking forward, we anticipate multiple staffing segments to outperform, including, but not limited to, the IT staffing space, healthcare, and professional subsectors, as these end market fundamentals will continue to drive M&A needs going forward. So moving on to the next question is really, when comparing M&A across these markets, what types of buyers are transacting in each of these environments? So we're always going to see a mix of buyers in any type of market. That includes buyers focused on healthy deals with a long-term view of value, and buyers that are more opportunistic in nature, who are focused on distressed deals or picking up companies at lower valuations. So those groups definitely took advantage of those fundamentals during COVID. And part of the value that UHY adds is we're really aware of these lurking value shoppers in today's market and looking forward. And we would both identify and weed out these opportunistic buyers in a sell-side process and really target the buyers with a long-term view of both strategy and value. So finally, as we conclude this slide, we wanted to spend some time just discussing some of the unique COVID impacts on deals that took place during the pandemic versus our outlook on COVID's impact during future transactions. So during the pandemic, speed of close was really prioritized over value for distressed deals. So this was the majority of the deals that were getting done during the pandemic, and this was the main trade-off in a COVID environment. So we also saw unique rescue financing and alternative financing sources, such as PIPEs, or private investment in public equity, and government interventions, such as PPP loans, which I'm sure a lot of business owners took advantage of that are in attendance today. We saw more structure in deals inked during a COVID market, with buyers pushing for earnouts to really protect themselves from COVID's impact on the target's performance. And then finally, price discovery. So we saw significant value gaps across the board as sellers were accustomed to pre-pandemic valuations moving into a pandemic environment, while buyers looked to protect themselves from COVID risk by reducing valuations accordingly. So typically, whenever there's a significant value gap, we end up with either A, more structure on deals, or B, lower deal volume overall, until that value gap really closes over time. And then finally, just concluding, as we look forward, we've seen a lot of positive signs surrounding valuations in general and in the overall market dynamics, including in the staffing space. And healthy companies continue to trade at healthy multiples, so we don't want that message to be lost in today's market and obviously moving forward. But we'd like to mention that COVID will continue to have an impact on lenders' comfortability around leverage. As Jeremy mentioned, they've taken more of a cautious approach to leverage during the COVID environment, and we anticipate somewhat of that moving forward in the next 6 to 12 months. We will also anticipate buyers focusing and digging deeper on diligence as they look back on how the target has performed and recovered from COVID and what potential risks are inherently still in the business. This will most likely extend timelines throughout the process in general for the short term. And then finally, as we continue to look forward, it will start to become easier for buyers to understand some of these COVID-associated risks, hopefully shortening that diligence timeline and narrowing the value gap as we move into a more normalized environment. So having said all that, I'll now shift the reins back to Jeremy to discuss how the pandemic has really impacted deal valuations.
Thanks, Brandon. I think this is obviously a key question for most business owners. We've heard a lot in the market that business owners that were maybe close to a year or two away from potentially exiting, selling their business, that they feel like they've missed the window, or that the opportunity to sell at a high, robust valuation is in the past. And so that's why we want to talk a bit about the true impact on deal values of the pandemic. I think this will be interesting for folks to hear. So this is data on, again, we'll go back high level. We'll look again at staffing in a minute, but overall, valuations actually remain relatively high today. So we can see that in 2020, overall deal multiples have averaged around just north of 12 turns of EBITDA. While that's down slightly from 2019, we can see that if you look over the past 5 years, we're still trading at premium valuations today. So very, very encouraging sign. And I'd also say that to Brandon's point, a lot of the deals, a portion of the deals in 2020, we did see some distressed deals getting done. And typically in distressed transactions, you see lower valuation multiples, which just means to us that the healthy companies that were transacting in this market were probably trading slightly higher than this average would suggest. So, we haven't really seen a significant drop off in valuations at the overall market level. And if we look at the data purely in a staffing industry, we see some positive and encouraging trends here as well. So if you look back to multiples in 2008 and 2019, you see that we're pretty close, hovering around the 8 turns of EBITDA level. Whereas in 2020, we're actually just south of that, but we're at about 7.8 times. And if you, again, suggest that the healthier deals are getting done at slightly higher multiples, we haven't really missed a beat in terms of overall valuation. So I think it's important to understand that, A, deals are still getting done, and B, valuations have actually held in quite significantly over the years. So as an owner, you haven't really missed the window if a potential liquidity event is sort of on the horizon strategically for you. As we think about deal valuation in the M&A community, there's a lot that goes into valuing your business, a lot of different methodologies that buyers will go through. But fundamentally, we all think about value as a multiple of EBITDA. So those two components, EBITDA, which is really a proxy for net income or cash flow, is obviously a significant driver of value. The question for a business owner is, well, what's the important EBITDA number that buyers are going to be focused on? Is it 2019, where I've got clean numbers that, before the pandemic hit? Is it my forecast for 2020? Is it the last 12 months, which both of those are obviously likely to be impacted by COVID? Or is it looking forward to 2021 and 2022, knock on wood that hopefully we're past most of the impact of COVID? The answer, of course, is all those numbers are relevant, and there's, just like there's a story around your business, there's also a story around your numbers. But fundamentally, buyers do tend to gravitate towards a trailing 12-month EBITDA number. So as a seller, knowing that, what does that mean? Does that mean now that we have to wait 12 months to get fully past the impact of COVID? And the short answer is no, because of what we call EBITDAC, which is just EBITDA adjusted for COVID. And so what we're really doing there is we as advisors are trying to help buyers understand how your business is generating EBITDA or will throughout 2020 on an as if COVID didn't happen basis. And you might say, well, no one's gonna buy my business as if COVID didn't happen. It did happen. Well, the reason for that is because at the end of the day, as we're targeting buyers with a long-term view of your business, they're focused on your run rate EBITDA. What are you going to produce in 21 and 22 and 23? And so really making an adjustment for COVID helps them better understand that. So we're spending a lot of time with business owners before we go to market to understand what is the true impact of COVID, how much of that is temporary, how much of that is longer term in nature. And then the other side of the equation in terms of the multiple, we need to make sure we understand And we talked a little bit today about the overall market multiples. We talked about multiples in the staffing industry. It's important to understand how your subsector is performing as well. And Brandon's going to talk a little bit more about that later in the presentation. But the challenge we have is that both of these components of value have been significantly disrupted by COVID. So both buyers and sellers that are working on a valuation assessment, that exercise has just become quite a bit more complicated in this market. So let's take a look at on the EBITDA side of the equation. There's the normal assessments that buyers will look at when they're looking at your numbers. How are your revenues growing? Are you increasing revenue over the last several years? How are you performing relative to peers? And then from a profitability standpoint, are your margins expanding? Are they contracting? Are your margins lower than or equal to peers? Those are kind of all the typical analyses that buyers are running. But again, where we're more focused today is what type of a COVID adjustment do we need to be looking at? So again, if your revenue is down in 2020, is it due to temporary factors? Are you serving the auto industry where you had plant shutdowns for several months? Well, we all know that those plants have now reopened and are generating cash flow, and maybe that revenue is still coming back, but that's a temporary impact. And buyers with a long-term view of value understand that and can see through that. So again, we're spending a lot of time positioning your numbers in a way that buyers can understand them from a value perspective. And I'll hand it over to Brandon. He's going to talk a little bit more about the multiple side of the equation.
Yeah, thanks, Jeremy. So there are really a lot of factors that impact how buyers will apply a multiple to your business. And part of that is really your overall performance compared to the market, as well as your specific subsector. So buyers and investors really understand that the pandemic has radically impacted the staffing industry's overall profitability. For example, you'll see the chart on the screen. This outlines the latest staffing revenue forecast just released in September, showing a 17% decline in 2020 due to the pandemic. So if your business is down 15% in this environment, don't panic. You're actually outperforming the industry. So having said that, it is extremely important to understand your subsector and how that is performing versus the overall market, as this will have an impact on how the market and buyers assign value from a multiple perspective. So the slide on the screen now, you'll see the major staffing subsector projections broken out in each of the charts. So some subsectors have been more impacted than others, given the structural versus transient impacts to those end market fundamentals. So in general, for example, if you're down 15%, but you're in the industrial staffing space, then you're actually outperforming the industry as well as your subsector. So that will be viewed favorably from a buyer's perspective and ultimately from a value perspective. And on the flip side, if you're down 15%, but maybe you're in the healthcare space, then buyers may apply a discount when looking at your company's valuation. So this is really the type of analysis that owners should be aware of and performing relative to their specific subsector, as there is a unique story behind what's driving each group's profitability, how each subsector's dynamic will change as we move into a new normal environment, and how the market and buyers will ultimately assign value. So moving on to the next slide, we'll discuss just how the market assigned value during COVID-19. So the charts below are really snapshots of the overall value impact of the pandemic to each of the staffing industry's major subsectors, as there were both significant asset value reductions and multiple contractions to all staffing subsectors as a result of COVID-19. So on the left, you'll see even IT staffing was down 49% from a share price perspective, public companies in that space. And then on the right, we see how those public company multiples were impacted. Now we've discounted those to account for a size and liquidity perspective and kind of view it more towards a middle market perspective. So you'll just see even the IT space in general was down 2.5 turns. And even the healthcare space took an even bigger hit, which was down about 3.3 turns of EBITDA. this just goes to show that really no one was safe from the initial shock of COVID-19. And since COVID-19's initial shock, as we all are living through, we've seen significant recovery across the board from late March through today, with certain subsectors, including the subsectors that were most significantly impacted, even outperforming their pre-pandemic levels from both an asset value and multiple perspective. So the IT sector is actually now trading higher than it was at pre-pandemic levels that we saw on the last page, and light industrial / commercial sector has even climbed back to its previous trading multiple. Now, some subsectors will take some more time to make a full recovery, including the professional staffing space, executive search, and healthcare, which typically lags all subsectors, as it's really just lagging the overall staffing market in general, typically from a recovery standpoint, as well as the upcoming election may actually impact demand for healthcare staffing, depending on the results of that said election. So we're really seeing healthcare recovery in that wait and see mode. So now that we've really delved and talked about the deal valuations, I'll pass it back to Jeremy for him to discuss COVID-19's impact on the M&A lifecycle, including deal process and terms.
Thanks, Brandon. Well, obviously, we've spent a fair amount of time talking about deal value, deal volume. And again, if you talk to folks in the M&A community, very clearly the pandemic has impacted really all phases of the M&A life cycle. And so we'll talk about a few examples of each of those just to illustrate that point. So as we talk about the pre-sale preparation process, this is sort of all the things that business owners are doing or should be doing before going to market. We did a lot of this beforehand, but there's certain nuances with COVID that are impacting how we approach some of these assessments. So first of all, your historical financials. We really have to do a lot more work today, trying to remove the noise of the impact of COVID. Again, we're trying to position EBITDA and your financials from a run rate perspective. So we're spending a lot of time digging into the true impact of COVID, when we think it's going to recover. We're being very transparent in our process because buyers ultimately will need to diligence our numbers and our assumptions here. So we're doing a lot more preemptive sell-side quality of earnings assessments. So this is really, we're really doing the diligence that a buyer is going to do later in the process. We're doing that up front so that we really see where we sit from a buyer's perspective. That may suggest to us that we've got to continue to recover before we go to market. Perhaps we've got to do things, perhaps we've got to grow through acquisition or organic growth, but it really sets out the framework of where we are today. From a forecasting perspective, it used to be sufficient in the past for buyers to ask sellers, what do you anticipate growth to look like in the year ahead? Well, in the past, we used to say, well, we think we'll be up 5 or 10%. Buyers would take that, plug it into their model, and come up with their valuation. Well, with the advent of COVID, the challenge is, buyers don't really understand fully how quickly we're going to recover, right? Are we going to recover in 2 months? Are we going to recover in 2 years? So what we're doing is spending a lot more time with business owners, looking at their company, forecasting the business on a monthly basis, at least for the next 12 months, on a by customer basis, on a by end market basis, because we really need to dig into that level of granularity so that our forecast holds up in diligence ultimately when buyers dig in. And what we're really trying to do ultimately with this forecast is illustrate to buyers what the roadmap to recovery actually looks like. So taking those two components together, valuation assessments, we're doing a lot more of this work because it's really important for business owners to understand a realistic view of value for their company, because it helps them illustrate whether or not they want to sell in this market. Perhaps they need to grow into their valuation over the next several years. It really helps illustrate sort of a framework for the future. It's really important to have the right team to go through this exercise with you as well. The sale process itself, we're kind of running up on time here, so I'll kind of go through these pages relatively quickly. We're seeing longer lead times. We know that lenders are doing more diligence, Buyers are doing more diligence, so we are allowing them more time in our sale process to get through that work. Obviously, management meetings, site tours, these are all really important aspects of a deal. But with COVID, we've been restricted on a lot of these in-person meetings, so we've been having to do a lot of this work virtually. One of the unique positives that's come out of this is, instead of, from the buyer's standpoint, just the CEO or the business owner participating in these meetings, you've got more than the travel team. Now we've got mid-level management that's available to participate in these calls, learn more about the business, really helps buyers make a more informed decision. And then ultimately, vetting offers, right? Whether it's an initial offer or an LOI, a letter of intent. We are spending time as sellers advisors, really making sure that, has that offer been reviewed by the board? Has it been reviewed by the investment committee of a private equity fund? Has it been reviewed and assessed by their lenders? So we're really trying to de-risk these deals. And frankly, if you're a buyer, the more confidence you can give to sellers that you've done all this work in advance can really make a big difference. For a buyer to say, we can close in 60 days, that is music to sellers' ears, especially in this market. So again, being flexible in the deal process has been really important. I'm not going to spend any time on this page. This is really talking about key terms in a transaction. Geoff is going to spend a bit more time talking about some of the risk management aspects and how that's been impacted by the pandemic as well. I go back to valuation though. It is literally our job as advisors to guide buyers to a value maximizing outcome. So whereas we see a lot of deals that are put on hold, we are trying to do everything we can up front to make sure that buyers have the ammo they need to go to their lenders, to go to their boards and investment committees with the right data and the right story to articulate the strength of your business. Again, it's really critical to have the right team to go through that exercise. And a bit of a plug for UHY, we truly have been one of the most active middle market M&A firms. We've closed 6 deals since late March, which is remarkable in a market like this. Again, I would also note that these deals that we closed, all of which have been done at pre-pandemic valuation levels. And interestingly, several of these companies were actually fully shut down at the time of closing. So again, can you sell yourself in this market? Is M&A getting done? Absolutely yes. It's just become more challenging. You've got to have the right team in place and you need to be adaptable. So my last set of slides here is really, okay, so having said all this, what should business owners be doing in this market? I think simply put is be proactive. PPP loans is a good example. Take advantage of these. These are literally meant to be support lines for your company. There's many other programs out there as well. Take advantage. Your peers are likely also very distracted in this market. So what are things you can be doing to take advantage of that? Can you pick up new customers? Can you enter new markets? Be proactive thinking about those things when, again, your peers are probably distracted by COVID. Look at your cost structure. Always have an always-on M&A strategy. Whether or not you plan to do something in this market, be informed, get your team informed, assemble the right team, understand the dynamics that are happening in your market so that you have an opportunity to play a role in that dynamic. And then finally, take the time to understand how buyers are going to look at your numbers. Perhaps go through a pre-sale preparation process like we talked about. This is what I mentioned before. Accenture has done a study to really look at companies, publicly traded companies that have been active in M&A in downturns, and we see that those companies tend to generate 22% excess returns over peers that have not. And the returns for those that did deals during pandemics is even higher. So this kind of illustrates some of the value of having an always-on proactive M&A strategy. And then finally, the value of going through a pre-sale preparation process, whether you're looking to sell your business now or in 5 years, we can help go through this exercise of understanding your numbers from a buyer's perspective. Take a look at that forecast and figure out how you're going to grow over the next several years. Take those two components, understand what your value is today in this market, and come away from that with an understanding of what you're worth today if you need to or want to sell, or what are the things you need to do what are the 3 to 4 things you need to do over the next 3 years to enhance value? This exercise can be very eye-opening for business owners to go through. So with that, I'll hand it over to Geoff at Odell Studner to walk through the company and some of the risk management aspects of COVID.
Thanks, guys. Welcome, everybody. I'm going to go light speed here. So we're going to blow through a few slides. So suffice it to say, we're a large player in the space, national in scope. You can jump slides, Jeremy. Roughly, we're part of a network of agencies similar. We're all specialists. Our specialty happens to be staffing. We're roughly $2 billion in revenue, highly acquisitive. So we were doing about roughly 100 some odd deals ourselves every year. So being involved on that acquisitive end, we're certainly up to speed on deal structures and flow. So if you want to hop forward here, next one if you could. So intent here is to give you a quick insurance market update, really with specific levers identified and then practical recommendations generated as a result. So in general, we're bullish about M&A in the space. With that said, we're seeing lack of preparation based on market change, creating significant deal pain at really the valuation point and closing. So really what we're talking about here, guys, is not LOI generation, but getting to the close with a focus on value, both for the seller and for the buyer. So if you really think about the two major levers that are going on right now that are impacting from an insurance perspective, it's actually a cross-section of two things happening. One, an insurance hard market, which is a cyclical process where we're talking about availability and pricing. So that hard market really is about economic drivers coupled with catastrophic events, creating a scenario where insurance companies are no longer generating investment return in all areas and begin to squeeze their appetite for business while at the same time increasing premiums to account for it. You'll see the biggest spike happened as a result of the recession back in 2008. If you follow these slides quarter by quarter, all the way with the height being in the fourth quarter of 2012, we saw that drop for a sustained period of time, but slowly but surely we've seen that ramp back up for 11 consecutive quarters right now. So for a period of time, we could create insulated pockets that would protect clients for expansion of appetite and new deal opportunities, while also giving flexibility based on lack of data to be able to structure new programs. With the pandemic hitting, really, COVID's changed that appetite. We no longer are seeing that flexibility. If you switch to the next slide, Jeremy. Really what we're talking about is a scenario here where the two big issues I think at play are both from a buy side and a sell side are diversification versus recovery, right? So as players on the sell side are looking at ways to represent themselves in the recovery of their business, they themselves are either looking at two things, getting very granular and supportive of existing clients. I'm sure many of you guys can feel the pain of the statement of I have X number of open recs, but I just can't find the people to place, leading typically to a scenario of diversification and entering of new markets to bolster really new growth and hopefully revenue generation, cash flow. So these new specialty lines, unfortunately, on the insurance side of the world, create a scenario where market availability for both protection for contracts with the correlating liabilities associated with those specialties, like engineering, IT, and healthcare, are creating deal pain for folks to be able to actually place coverage in a way that they can not only move their deals forward, but do it in a cost-effective manner. So if you want to click to the next slide. This is really illustrating to you really two things. Really, the idea of the insurance marketplace in general is a very complex deal-making operation. It's bookkeeping. So every insurer that takes your risk on is in fact offloading much of that risk behind the scenes with reinsurers or other players that are taking a piece of the risk that they would be retaining. So in turn, as that capacity or availability of product begins to become constrained, once again, appetite becomes even more tight. If you want to switch slides here for a second. And you start to see a scenario where when you couple that with an industry that was already considered to be not high on the appetite board, feeling significant pain, although seeing some recovery, all of a sudden the appetite of those carriers becomes much more constricted. If you want to switch to the next slide. So once again, as folks enter specific specialty markets and look to diversify, construction, healthcare, transportation, engineering, anything that we would consider to be specialty classes for diversification, even going so far as to say SOW work, compliance work, training work, things that go outside of core, what we're starting to find based on that drop in the staffing industry in general, when you put those converging lines of hard market into that drop of revenue, buyers are starting to become much more critical of the business that they're buying, trying to get granular and understand what they're actually looking at. And sellers are unfortunately diversifying or looking to diversify into new markets just as quickly. You can switch the slide. You can switch this slide. You can jump over this one. All right, so real quick, we're going to jump into the sell side piece very quickly. So if you take a quick look, this is all about the preparation piece. So what we talked about earlier in the slides with Jeremy and Brandon, this is really all about identifying your team, making sure that team understands who you are and what your intention is. So by doing so, they can be very realistic with you about what it is your data and is telling, and what that story, what that picture paints. What you want to be know ahead of the curve is, what are you trying to accomplish with your deal? And have you gone through all of your historical data coupled with what's happened with COVID? And are you prepared to be able to tell a story and anticipate what's going to be asked for on the other side of due diligence? We're going to see that slide in a second. And I can tell you for pure fact, if I'm the player on the other side from a due diligence perspective, please be prepared and understand we're going to be looking for granular level data to be able to ensure that our client is prepared for the deal, prepared for the cost structures, and understands clearly what their liabilities might look like. So as a result, we're talking about what that risk snapshot is, purely understanding who you are, what that structure might look like, what's changed geographically, demographically, from a risk-centric perspective. Have you gone into new areas? What kind of contracts have you signed, and what are the implications of it? And then to do a deal, what are the tools that I have available to me if I'm going to be able to move forward here? Well, having a clear understanding that there's data analytic tools to be able to help you prepare. There are also insurance products that can help you prepare to be able to get the sale. You want to switch the slide quickly? All right, buy side preparation. It's really the converse of all of what I just described from a sell side preparation standpoint. Really, number one, look in the mirror, know who you are. There's competition out there to do deals. If you're going to go into the distress space, make sure you have your team assembled behind the scenes, either internally or externally, to be able to gather that data quickly, put it in the data room, and make sure that you can overlay it with an analysis that makes sure you get lift from the deal, or you understand very clearly what it does to your program behind the scenes. So this isn't just about insurance programs. This is about liabilities. You want to have a clear understanding of the contracts that are being signed out there, because I'm preparing you. There are some very odd new indemnification clauses and liabilities being absorbed by sellers that you need to have your eyes on. It's not just about getting a sampling. So with that said, you also want to make sure you are very clear about the deal structure you're looking at, and also the resources you have internally. The way we look at it, if you want to overlay kind of an accounting analogy to it, think about it in this way. When you go to your accountant, you ask, you're presented with really three options: compiled, reviewed, or audited, typically being driven by an outside party as to what you need internally. But if you think about it, compiled really just means I have a checklist. I'm gathering data based on that checklist to make sure that those things are in place. I haven't actually looked at them to ensure that they're actually being used. On a reviewed basis, I'm gathering that data and I'm actually reviewing it to make sure that they're in place. On an audited basis, not only am I reviewing them to look and see if they're in place, I'm actually taking a deep dive to make sure that what is in place, what's being said is being used, is actually having the desired outcome and that there aren't any landmines waiting associated inside. From a risk management standpoint, once you have your philosophy established, be prepared really with these three kind of elements that I think are important. One, have an on-site operational review of what that company has from a best practice standpoint, overlaid with what yours is. If it's a completely new area of business, a segment of business, you need to be prepared with a plan to be able to execute on the back end of it, and then have some metrics prepared associated with what's acceptable to make the deal make sense. Look at credit insurance. It's still available. You'd think during a time of economic uncertainty, credit insurance wouldn't be available, kind of like buying a mortgage during the recession, but in fact it is. And you can insure the receivables and contracts that are put in place on that deal day one that can give you some added protection. And last, look at bifurcating your insurance program, isolating risk. You can do that under different structures, but it also allows you to take advantage of really isolating the deal for performance for holdbacks and earnouts that may come later in deal structuring. And then last but not least, post-deal integration. Jeremy touched on this from a process standpoint. This is about having a plan post-execution. This isn't just about going and buying a shiny new car or toy. This is about doing a deal that actually works and makes sense for the future. Do you want to pop to the next slide? This is just an example of level of due diligence that needs to be done in terms of cost analysis, pre and post deal, understanding actual run rate. This is a deal that would be very akin to what we would have been doing, what we're already doing post and pre and post pandemic, understanding run rate projection, where the business was and where it's going. So if you want to click here. Really, that's it. I think I would just say, I'm going to turn it back to Jerry. From my perspective, I think myself and Odell Studner are a perfect example of what the UHY team established about picking the team and understanding during the pre-sale and pre-due diligence process, making sure you have the right players involved so that you have the data and knowledge that you need to be able to execute really with the best valuation in mind.
Thanks, Geoff. Appreciate it. Jeremy, thank you. Brandon, thank you. We did have a couple questions come through that I'll ask for some feedback from you guys. Geoff, I'll start with you. You know, you've seen in this insurance issue, and I know you talked a little bit about it, but you know, the due diligence process, because you've worked on a lot of deals as well. What is one of the biggest mistakes you've seen, or the biggest issue you've seen during that due diligence, whether you're the buyer or the seller?
Yeah, so I'm going to put this right on the bucket from a seller's perspective. If you think about it from an AR perspective, during a deal, you would want to get very clear understanding within deal structure in terms of assets and liabilities, who would own and retain the AR floating post a deal, whether that's an asset or stock purchase. There's, you know, it's really a deal centric point. With that said, those same concepts apply to ongoing litigation. They, in terms of collateral and security obligations, depending on structure of the deal, we've seen folks get to really the 11th hour and not have a clear understanding of what their real liabilities might be. And really, it's just a question of, you know, if somebody's being advised in a don't ask, don't tell, if you haven't been asked, don't tell mentality, you need to be very careful about what you might be walking into. There are products to protect you with stuff like that in terms of reps and warranty, but they are all things that could be handled in the pre-sale process.
Excellent, thanks. And next question that I really, I've been seeing tons of questions on this, and we're doing a lot of work on this issue. You know, Jeremy, on a business sale, how does that impact the PPP loan forgiveness? You know, my insight working with multiple owners and multiple lawyers, we have been structuring those so that, one, they do get forgiven, number one, but number two, they're also used as part of the whole deal structure. And I think it's a great avenue, and you've touched on it a little bit. So you want to just kind of expand a little bit more on it, on these PPPs and how it's what you see happening so far?
Yeah, this is just really another example of going through a sale process today. There's always challenges and things to look out for in diligence, and add PPP to the list, right? So, as a seller, isolating that cash, making sure that you're tracking the use of those proceeds, that's an area where, the way that PPP was rolled out, it was quick. It's not black and white in all cases. So we've had a lot of business owners that are kind of doing that work themselves. If you feel like you need some help, whether it's tracking or sort of put a second eyes on that, we've got a dedicated team at UHY that is doing that work. But I would say, again, it's just another due diligence item on the list. I mentioned it before. One of the questions that's come up on a lot of deals is, okay, so we've got this PPP loan on the books. The company sells. So, there is some post-close risk of whether or not that loan gets forgiven, or, all of it or a portion of it gets forgiven. So who owns that risk? Is it the seller? Is it the buyer? I think in most cases, buyers are either doing a heck of a lot of diligence around that piece, or they're making the seller kind of own that risk effectively. So I've seen it both ways, but I think the best way to do that is for buyers and sellers to be very transparent about that process, make sure that those proceeds are being used correctly to best position for eventual forgiveness. But again, it's just another point of diligence and negotiation ultimately on deals.
Excellent. Well, that's all the questions that had popped up. I appreciate both of you, all three of you being on the presentation for us. There's a lot of good information out there. It's great to see that, the marketplace is recovering, but more importantly, that it's still active and will be active. And I think that, having a different perspective, both from the business finance side and also the risk side, is really big, because I know a lot of deals I get into, usually it's not a team approach. And I think, Geoff, you summed it best. It really needs to be a team approach, because there are so many things that can go wrong. And risk is one of those, especially around the insurance, the AR insurance policies, those types of things are positive, and something that all deals we should be all looking at to help implement. With that, guys, I'd like to thank you. And we will be getting the presentation out to everybody in a PDF format sometime in the next day or so. You should see it. All our contact information, everything you need is right there for you as well. Thanks so much, guys. Take care.